Hi guys, and welcome to the final exam review.
Okay, moving on to some questions over Chapter 10, which was auditing the revenue process. Question 1, agreeing copies of sales invoices to their respective shipping documents provide evidence that what? Okay, so we know key to these questions is always the order, right? And this implies I'm kind of starting from a population of sales invoices, and I'm finding their shipping docs as support for the invoices. If you read this directionally, because I'm going and finding the respective shipping documents for sales invoices that I already have. All right, so what that means is what I'm looking for in terms of answers is something that tells me that the evidence I have here is that I'm going to find evidence that sales that were billed were actually shipped, something like that. Or sales that were invoiced were actually shipped. So shipments to customers were recorded as receivables. No, this would be starting from a population of shipments and then looking at AR. Billed sales were shipped. Yes, this is exactly what I was looking for. AR is complete. That would be something about looking at an AR reconciliation. And shipments to customers were billed. That would be something like agreeing shipping documents to their respective invoices, right? So B is my answer. Which of the following is not an inherent risk factor for the revenue process? Okay, so remember in class when we talked about inherent risk factors for revenue, we talked through some examples. So we talked about things like the percentage completion method of revenue recognition, right? We were talking about complex ways of recognizing revenue, and we were saying, hey, these complex ways of recognizing revenue often relate to special industry practices, and these often are really difficult to audit. So we had this example with the construction industry and specifically with road construction. And also we talked about another example being the kind of healthcare industry. Okay, so all these are inherent risk factors. And D, the entity does not follow its stated policies for sale order approvals. Okay, so the other thing that makes this unique, if you didn't necessarily remember that these were inherent risk factors, is if you read through this sounds suspiciously like a control failing, right? This sounds like a control activity, and it's saying, hey, they're not following this control activity. So this is really a control risk, not an inherent risk, right? Because remember, inherent risks represent things that make accounts inherently more likely to be misstated absent control activities or before control activities are put into place. Okay, so our answer there is D. Right, question 3. Which of the following is the best argument against use of negative AR confirmations? Okay, so remember we had our positive and our negative AR confirmations. And the positive AR confirmations say, okay, respond yes or no. And the negative AR confirmations say what? They say only reply if the answer is no. We talked about the risk of the negative AR confirmation being if I don't get a response, which okay, with my positive AR confirmations, if I send 3 rounds of these things, I may only get a 50% response rate. So if I ask for them to only respond if the answer is no, then how do I know if, when I don't get it back, do I really know if the answer is no? Or am I just getting like a crappy response rate? So I want some answer that's probably going to tell me something along that line. Okay, so the cost per response is excessively high. Obviously, positive AR confirmations are going to be more costly for auditors and for customers and for the client than negative AR confirmations, right? They clearly require more work. They want people to reply whether the answer is yes or no. They require auditors to follow up on non-responses, right? And so positive AR confirmations are going to be more costly than negative AR confirmations. So A is not our answer. B, there is no way of knowing the intended recipients received them. B is definitely true. I don't know if it's the best argument. We have to read the rest of the answers, but B is true. We'll have to see the rest. All right. C, recipients are likely to feel that in reality, the confirmation is a subtle request for payment. So this does happen, but this is true for both positive and negative confirmations. Okay, so yeah, it's not going to be our answer in terms of being an argument against negative confirmations, because it would be true either way. And D is the inference drawn from receiving no reply may not be correct. All right, this is our best answer, right? That completely encompasses what we said at the beginning of all this. We don't know if a no reply means bad response rate or it means they actually, they actually agreed with us. That's one option. They agreed. Or it could mean answer B, right? It could mean they never got them, didn't get. So there's just so many options if you don't receive it back as to why you didn't receive it back. And so that's why, negative AR confirmations aren't great. So the problem with answer B is it's just too narrow when compared to answer D, which encompasses all this. So answer B is really subsumed or encompassed by answer D, which is our best answer. So we can officially strike out answer B, and we know answer D is our best answer. So question 4, which of the following controls most likely would be effective in offsetting tendency of sales personnel to maximize sales volume at the expense of high bad debt write-offs? Okay, A, employees responsible for authorizing sales and bad debt write-offs are denied access to cash. This doesn't sound great because it sounds like these are two parties, right? So it sounds like one party can both authorize sales and write-offs, which we'd want to separate those two. According to this risk, those two things kind of should be separated. And it just seems like it's separating this party who gets to do both those things from having access to cash. It's a nice segregation of duties because it's separating authorization and custody, but it really has nothing to do with the risk at hand discussed in the question. So A is not a good answer for us here. Okay, B, shipping documents and sales invoices are matched by an employee who does not have authority to write off bad debts. Again, this just has nothing to do with the question. So So B, on the one hand, we have somebody who talks about maximizing sales volume. So this is somebody who authorizes sales. And high bad debt write-offs. This needs to either be like a credit granting function. So we have two ways of kind of going about this control. One is we need to prevent this from happening in the first place. And if we want to prevent this risk from happening in the first place, we would want to separate sales authorizations from some kind of credit granting function. Number two option to go about this risk would be to detect things after the fact. So if we want to just detect this risk after the fact, we would want to separate sales authorizations from authorization of bad debt write-offs. Well, this one basically talks about matching shipping docs and sales invoices, which sounds like, I don't know, maybe something you would do, possibly before you sent out the sales invoice, possibly before you recorded something in AR. We don't know why they're matching those two documents, right? Because it doesn't really explain it. Or are they just matching it as a control activity to make sure there's a two-way match there? So this employee is matching them, and whoever's matching them doesn't have the authority to write off bad debts. All right, so we have one thing, which was authority to write off bad debt. So that's kind of one side of the coin, but we don't have the sales authorization. It's not present in our answer. So if we had the authority to write off bad debts, and if this part said this was a person who authorized sales, it could work for us, but it doesn't say that, so this guy doesn't work either. Okay, employees involved in the credit granting function are separated from the sales function. Okay, this control will work, and like I said, this control will prevent the risk that is discussed up here in the question, right? Because it stops this, which is going to be the people that are trying to, the sales function, these are going to be the people trying to maximize sales volume. And they won't be able to sell to customers that are a bad credit risk, which those would be the customers who would cause the high bad debt write-offs. So they won't be able to sell to those customers if the credit granting function is separate from the sales function, right? Because basically they will only be able to sell to customers for whom basically sales have already been approved up to X limit, right? So I can only sell to customers that have like a credit limit of up to $1 million or a credit limit of up to 50,000. So somebody else has already gone through and decided what their credit limit should be, what their terms of sale should be, right? So somebody else has already done that, and that person's incentives are to make sure that I only sell to creditworthy customers. And now I'm coming through, my incentives are to maximize sales volume, but I can only do that to customers who have been previously determined to be creditworthy. Okay, so this control will work for me. And then last but not least, D says subsidiary AR records are reconciled to the control account by an employee independent of credit authorization. So again, I have a credit authorization here, but reconciling the AR records has nothing to do with actually authorizing sales, right? This is something that occurs long after the sale has taken place, so it does not really help me in terms of the risk discussed here in the question, so D also does not work. Okay, so moving on to chapter 11. Number 1, to determine whether AP are complete, an auditor performs a test to verify that all merchandise received is recorded. The population of documents for this test consists of what? Okay, so this implies we want to go from receipts to records, right? So it kind of determines I have a complete population here, and I want to go to recorded. So this sounds kind of like a classic test of completeness, where I'm going from some kind of supporting document here, which is going to be some kind of receiving reports, over here to some kind of records of goods received. Okay, or inventory in, right? So clearly I'm starting from here, which is going to be, should be something like receiving reports. Let's see if any of these other things will work. Payment vouchers, no. Purchase requisitions, that would be where I originally wanted to purchase it, but it won't show me what I actually received. This is going to show me where I paid for the stuff, but not where I received it. And this will show me where I paid for the stuff, but not where I received it. So yeah, B, receiving reports, is my best answer here. Okay, question 2. When testing the existence of purchase transactions, which of the following procedures is most likely to be used by the auditor? All right, so I likely want some kind of vouching activity, vouching of vouchers, right? Okay, so observing segregation of duties. So we said this could work. So this is the problem because the question says most likely, right? So this is definitely a kind of tricky best answer question where I'm going to have to read everything, because observing segregation of duties could work here. It is a test of existence occurrence, but is it really the best test? Is it the one the auditor is most likely to rely on? No. Like an observation is a very nice supplemental test of existence occurrence, but is it likely to be their main test? Probably not. Okay. Agreeing a sample of entries in the voucher register to supporting documents. In other words, vouchers. Yes, I think this is going to be my best answer choice, and this is exactly what I was looking for. AP confirmations we said this is mostly a test of completeness for AP, but it does also test existence of AP. However, this asked really about occurrence of purchase transactions. So remember, this is kind of the subtle difference between what is going on with the class of transactions side versus the kind of balance sheet side. So since this is asking about the class of transactions side, we're really worried about, hey, what's going on with answers A and B being more appropriate, not this balance sheet account stuff. And obtaining a sample of unpaid bills and determining if they're reflected in AP. This is referring to kind of those activities we do at the end to search for unrecorded liabilities. So this is an AP completeness test and also will not work. So B is going to be our best answer in terms of most likely. A would also work, but it's definitely not the best answer when compared with B. Okay, so question 3 says an internal control questionnaire indicates an approved receiving report is required to accompany every check request for payment of merch. Which of the following procedures provides the greatest assurance this control is operating effectively? Okay, so if we read through the answers, there's a couple things going on. One is some of these answers, A and B say okay, we're pulling from a population of receiving reports, right? And answer C and D say no, you pull from a population of canceled checks. So that's one part of this question. The other part of this question is, okay, we have this whole what should be dated first aspect. Okay, so let's pull back and read this again. Okay, so an approved receiving report is required to accompany every check request for payment of merch. Okay, so we know in the payment process, right, this is clearly addressing the risk that I would be writing a check to a vendor who hadn't actually sent me the stuff I bought yet, right? So in other words, I should get the receiving report in terms of order of events. I should get the receiving report. I should probably also be getting the vendor invoice. And then at that point, I'm going to fill out my check request. And then I'm going to issue my actual check. And then after that check is actually paid, I will be able to see the canceled check reflected in my bank account, right? Because we said the canceled check is basically the check you have already paid. It has gone through the whole payment process. So let's put some sample dates in here too. So I can, let's say this is December 10th. So maybe my check request is December 14th, and then my canceled check can be 12/20, something like that. So first question is, which population would I want to be pulling my sample from? Receiving reports or canceled checks? Because that's going to help me narrow down this answer real fast to A and B or C and D. All right, so thinking from the bigger picture about the risk is really that I am paying for stuff I haven't received. If I'm worried that I am paying customers for things that I haven't received, I would want to start from a population of payments. So basically I can check, if I start from a population of payments, then I can check some of the payments and then make sure for all these payments, can you show me supporting documents that justify that payment of cash? So the issue, if I start from my receiving reports, and collect a sample of those, and I see, okay, for every receiving report, I have a check. All that tells me is that goods that were received, that I have these receiving reports for, are paid, but it doesn't tell me every time I send out a payment, I have supporting documentation in a receiving report, right? Because the risk is, hey, maybe people in the check disbursements department are cutting checks to themselves right? And there's no actual support for these items. No goods were ever received. There's no, receiving report. There's no vendor invoice. There's no support for these things. It's just these people who have the ability to write checks are very happily sending themselves all kinds of checks from the system. So that's really the risk being addressed. So that's one thing to think about with these questions is, okay, what is the greater risk being addressed here? The greater risk being addressed is that people could be issuing themselves checks from the company's kind of coffers, I guess. So this helps me eliminate choice A, choice B. Then I look at the dates, okay? And I need an answer that's going to say basically that the receiving report should be dated earlier than the canceled check, because that is going to show the fact that I received the stuff before I paid for it. So this one says receiving reports are dated no earlier than the canceled checks, meaning, in other words, they're dated later than the checks, which is wrong. And this says receiving reports are dated no later than the checks, meaning they should be dated earlier than the checks, which is correct. Okay, so this is definitely, I think, probably the most difficult question in the review, in my opinion. One, we have to think through, really, it's not even necessarily the order for the control this time. It's thinking through the bigger risk associated with this control. And then two, we have this language to me is very confusing. This no earlier, no later. So you almost have to reword it to make it less confusing. And for me, like, writing out examples with dates is very helpful here. Okay, moving on. Question 4. In auditing AP, an auditor's procedures most likely would focus primarily on completeness, right? We're worried about understatement. While in auditing AR, an auditor focuses mostly on existence. We're mostly worried about overstatement. That looks like C. And remember, in terms of this answer, okay, in AP, we spend most of our time doing the AP search. The AP search does help me establish cutoff. It is partially a test of cutoff, but it is primarily a test of completeness. Okay, because this is what trips some people up on this question. They think about the AP search and they think AP search is a cutoff test. So AP search is primarily, for number 1, a test of completeness. Number 2, yes, it is also helping me with cutoff, obviously. Chapter 16, auditing, financing, investing. So question 1, examining broker's advices for a sample of securities purchased during the year will help me test what? Okay, so this sounds like I am trying to support purchase transactions with supporting documentation, right? So clearly I have a list of purchases, the advices, the purchases are clearly listed in the record somewhere. The broker's advices are supporting docs in this scenario. So this is a test of existence occurrence. And broker's advices are kind of like, I feel like sometimes people ask me what this is. It's kind of like a confirmation letter you would get from the broker after you make a trade saying, yes, the trade went through for this many shares at this price on this date, right? Okay. In a manufacturing company, which of the following audit procedures would give the least assurance for existence for the GL balance of investment in stocks and bonds? Confirmation of the custodian. Well, we know that this is a very good procedure for ending balance. Okay, inspection and count of stocks and bonds at year end. We didn't extensively talk about this in lecture, but we know this works. Like, physical inspection was on the list of things that are okay. All right, vouching all changes during the year to brokers' advices and statements. It helps me with changes, but not my ending balance per se. An examination of canceled checks issued in payment of securities purchased during the year. Okay, so again, this is a type of change that happened during the year. It doesn't help me with my ending balance per se. So how do I tell the difference between C and D? What I want to think about is how much of the change is being examined or supported. And let's think about the case of a recurring audit, right? So I have the 12/31/18 investments balance, and I'm trying, and the 12/31/19 investments balance. This is what I'm trying to audit, right? This is what is on the current year balance sheet. But let's say, for sake of argument, that in prior year I got comfortable with the 12/31/18 balance, and I did audit this balance last year. So in other words, the 12/31/18 ending balance last year, this is my beginning balance this year, right? And this is my ending balance, of course. So what are the changes that are occurring in my balance during the year for investments? It's going to be add-ins or purchases minus sales. And there may be some other minor things here or there, but it's mostly add in those purchases, take out those sales, right? Those are my big changes. So the nice thing about C is it's vouching all changes, and D is just looking at purchases. So in other words, C is looking at all of this, and assuming that I'm already okay with my beginning balance, I would then could effectively get good with my ending balance by being good with the beginning balance plus the changes. D, if all I'm good with is purchases, then okay, let's say I'm good with my beginning balance, right? Because it's last year's ending balance. I'm good with the purchases. I still wouldn't be good with this year's ending balances because I have no coverage of this year's sales. So D is least effective here in terms of comparing between C and D. D is the least effective in terms of providing me with the least assurance. Okay, so D is my best answer here. Question 3. When testing a bank reconciliation, I use all of the following except what? Okay, I know I use my cutoff bank statement because that's how I test deposits in transit and outstanding checks. The year-end bank statement, I suppose I could use this to test the balance per bank. Ideally, I am getting a bank confirmation to test the balance per bank, so I won't need the year-end bank statement. I could also be using the year-end bank statement to test any bank charges. Right? I could be agreeing bank charges that I see on the bank rec to the year-end bank statement. So there may be uses for that. Bank confirmation, yes, this is my balance per bank. And proof of cash. I know the proof of cash is not useful when testing the bank reconciliation. Proof of cash is to test changes in balance during the month. It is not for testing a period end balance. And proof of cash was one of the fraud testing procedures we talked about, where you would kind of vouch the cash disbursements and cash receipts that occur during the period. So it's basically if you think there's a problem with disbursements and receipts during the period, not if you think that you think the ending balance is fine. Okay, so proof of cash is the one we would not be using here. Okay, an auditor should trace interbank transfers for the last part of the audit period and the first part of the subsequent period to detect what? All right, so I have this kind of trigger phrase up here in my question, which we know if I'm looking at interbank transfers, aka an interbank transfer schedule that's happening around cutoff time, interbank, that means kiting is going to be somewhere in these answer choices. So I'm hoping, yes, to see that. I see that in answer D. I mean, A is an okay choice, but you're really looking for kiting specifically. If I was just testing for cutoff, I'd be doing a very different test. I wouldn't just be looking at interbank transfers, right? For cutoff specifically, you're really looking at things external to the firm, right? Like receipts and disbursements that are external to the firm is what is most meaningful in terms of cutoff, because interbank transfers within the firm shouldn't matter in terms of cutoff because they're supposed to all be happening on the same day. Okay, an employee attempting to conceal defalcation of cash. Remember, this is a fancy term for misappropriation of assets or just theft of cash. May misstate reconciling items in the bank reconciliation to try to cover their tracks. Okay, so remember, theft of cash would likely cause your balance per bank to be too low and your balance per books in comparison to be too high, right? Because they wouldn't have been able to adjust. This assumes there's good segregation of duties, so they wouldn't have been able to correct or fix the records to reflect their theft of cash. So the records are still too high because the records don't reflect the theft, but the balance per bank does reflect the theft because the cash never got deposited. Okay, so potential strategies could include overstating deposits in transit or understating outstanding checks. And we know this is true because balance, if you think about the bank rec, we have the balance per bank. Deposits in transit are an add back. Outstanding checks are a subtract. And then you end with balance per book. Because of this, we're usually concerned with testing, ... Okay, so we're worried this guy is overstated or this guy is understated. So in other words, that means I'm worried about occurrence of DITs or completeness of outstanding checks. Right. If you struggled with that, go back to that section in 16 where we went through the bank reconciliation. But this is basically a matter of understanding, first, that this is going to be too low relative to this balance. And it's a matter of understanding that the deposits in transit are an add back versus the outstanding checks being a subtract. So if you struggled with this, one thing to do is go through a reconciliation and plug in some numbers, right? So plug in the fact that, hey, this could be 95K, this could be 120. Let's say there's no outstanding checks, deposits in transit should be 20. And so in order to make up my theft, I changed deposits in transit to 25. So you would go through and basically plug in some numbers to try to make sense of this. Chapter 17, completing the audit engagement. An auditor should obtain evidential matter relevant to all the following factors concerning third-party litigation against the entity except which, right? Period in which the underlying cause for legal action occurred. We know this is going to be important because I need to know, right, what fiscal year it happened in, because, for instance, let's say it's a subsequent event, right? I need to know, hey, is it a type 1 subsequent event that should be recorded in last fiscal year? Is it a type 2 fiscal event or subsequent event that would relate to the new fiscal year? Right? Because if it's something that becomes probable in a given fiscal year, that's the year that you need to record that contingent liability. So this is definitely important. So since this is an accept question, I know this can't be the answer. Probability of an unfavorable outcome. I know this is important, and I know this is in the legal letter because I need to know, is it probable, remote, reasonably possible? Jurisdiction in which the matter will be resolved. I don't remember seeing anything about that in the legal letter. So unless D is something even more weird, then C is looking like a pretty good answer. Right, D, existence of a situation indicating uncertainty as to the possible loss. Right, D is kind of similar to B, and it's getting at the same thing. So it's getting at the whole probability of an unfavorable outcome. So I think D is fine. You would want that information when you're finding about litigation against the entity. So therefore, I think C is our best answer here. You could theoretically come up with situations where this could be important. So if you're doing segment reporting geographically, like geographical segments, right? But in terms of which things are going to be important most of the time, A, B, and D are always going to be important, right? C may be important sometimes. Like if you can only construct a scenario where something might be important once in a while and the other answers are always important, then it's probably, the answers that are always important are okay. And the one answer where you have to construct the scenario for why it only works sometimes, that's probably the answer that's going to be wrong. Okay, question 2. Which of the following procedures would an auditor most likely perform to obtain evidence about subsequent events? All right, so we had a whole slide that listed different things the auditor had to do, right? They could read meeting minutes and get legal letters and look at interim financial statements. So reconcile bank activity for the month after the balance sheet date. Cash activity. So this is talking about a bank reconciliation, which is not, first of all, that is something the company should be doing. We would re-perform it as a control test as part of our cash audit or cash substantive tests, but it has nothing to do with subsequent events. So A is not the answer. B, obtain a letter from the attorney describing pending litigation's unasserted claims and loss contingencies. B is looking pretty good unless some other answer catches our eye. C, review the treasurer's monthly reports on temporary investments owned, purchased, sold. Again, this might be good when I'm auditing investments, right? My substantive test of investments, but I don't see how it relates to subsequent events. D, examine on a test basis the purchase invoice and receiving reports for several days after inventory. Okay, so this sounds like a good cutoff test for inventory purchasing, but not subsequent events. Last one. The auditor is auditing financial statements for year ended 12/31/09 and is completing the audit in early March 2010. The following situation has come to the auditor's attention. What type of subsequent event is it? And what is the appropriate action? Okay, so remember fiscal year end is 12/31/09. And it sounds like the audit opinion is early March. February 12th, 2010, the client agreed to out-of-court settlement on a property damage suit resulting from an accident caused by one of its delivery trucks. The accident was on 11/20/2009. An estimated loss of $30,000 was accrued in the 2009 financial statements, but the settlement was for $50,000. And assume the difference is material. Okay, so since the $30,000 was recorded here, since we're not issued yet, since it was a material difference, this is a type 1 subsequent event. I would go ahead and adjust this in my financial statements because I can take advantage of my 2020 hindsight. All right, so let's say this scenario was a little different. Let's say this said 1/20/2010, right? And it's still a material lawsuit, like could be material going forward. So I do decide I want to disclose it, right? So we can still say I want to disclose this, but in this case, right, my financial statements are perfectly fine as of 12/31/09. So it's definitely nothing to adjust there. So it'll still be type 2, and then I can disclose it. And that is it. Good luck studying. Email me, of course, if you are having any questions.